Welcome, everyone. I'm your host, and in today's explainer, we're going to absolutely dismantle a classic foundational assumption in economics. You see, for decades, traditional finance models have operated on this fairly bold premise that humans act completely rationally with their money. But let's be real. If you've ever held on to a losing stock just hoping it bounces back, or maybe bought into a market bubble purely out of FOMO, you know firsthand that the rational human is kind of just a myth. So today, we're exploring the fascinating, messy world of behavioral finance. All right, let's take a quick look at the syllabus for today. First, we'll compare traditional and behavioral finance. Then, we'll unpack key cognitive biases, look at the emotional influences on money, and explore the theories driving our financial decisions. After that, we'll scale it up to market impacts and herding, and finally, we'll wrap up with some practical strategies and applications. Let's kick things off with Section 1, Traditional versus Behavioral Finance. Think of traditional finance as the old-school way of doing things. It basically assumes we're all these perfectly logical, utility-maximizing robots. It relies heavily on frameworks like the efficient market hypothesis, which suggests that asset prices always perfectly reflect all available information. But then, on the other side of the coin, we have behavioral finance. This is a relatively new, much more realistic field. It completely recognizes the messy, emotional reality of human nature, integrating psychology and sociology to explain that we very often make completely irrational choices, even when we have perfect information sitting right in front of us. Those traditional models, they're all built around this mythical idea of the rational investor. By definition, this is someone who makes decisions based strictly on logic, objective analysis, and self-interest to maximize their utility. Sounds great on paper, right? But honestly, think about how we usually approach money in our day-to-day lives, or when running a small business. Are we ever really that perfectly objective? No way. And if that rational investor is just a myth, it begs a huge question. What is actually driving those suboptimal business and portfolio decisions? Why do incredibly smart, seasoned entrepreneurs continuously fall into the exact same financial traps? Which brings us right into Section 2, Unpacking Key Cognitive Biases. Here's the thing. Our brains are incredibly busy. To save energy, they use these little mental shortcuts, which psychologists call heuristics. Now, while these shortcuts are fantastic for everyday survival, in the highly complex world of finance, they cause us to stumble hard into cognitive biases. These are systematic, totally predictable errors in how we process information and make judgments. As Figure 1 on common cognitive errors outlines, this totally changes how we view real-world business slip-ups. Take a Vancouver tech startup founder, for example. Driven by overconfidence, they might aggressively overestimate their ability to predict market trends. Now, combine that with confirmation bias, meaning they're only reading industry reports that validate their original business plan and ignoring all the massive red flags, and suddenly this founder is taking on wild amounts of risk. They aren't lacking data at all. Their cognitive biases are just completely distorting it. And that perfectly sets up another major cognitive error, anchoring. This happens when you just fixate on a specific reference point, usually the first piece of information you hear. Imagine a Toronto boutique owner who bought a massive shipment of winter coats at $100 each. But now, unseasonable, super warm weather has completely ruined the market for coats. A purely rational investor would just sell them for whatever the current market dictates to free up cash. But our boutique owner? They are anchored to that $100 original cost, stubbornly refusing to discount the inventory and literally bleeding their business's cash flow dry in the process. So, knowing how easily our logic gets tripped up by these mental shortcuts, we have to dig a little deeper. We have to ask ourselves, are your choices really driven by logic, or are they secretly being driven by fear? Let's move into Section 3 and talk about the emotional influences on our money. Emotional biases are a whole different animal. Unlike cognitive errors, which are just about processing data incorrectly, emotional biases come straight from our gut feelings, fear, greed, regret. And because they're baked right into our evolutionary psychology, they are incredibly tough to shake. They're exactly what pushes otherwise brilliant investors to panic sell during a market dip or wildly speculate when times are good. If you want to see this in action, check out the loss aversion impact in Figure 2. This is Kahneman and Tversky's famous prospect theory, and it visually proves just how irrational our emotions are with money. The data clearly shows that the emotional pain of losing $1,000 is psychologically twice as powerful as the joy of gaining that exact same amount. We are literally hardwired to avoid losses at all costs. It totally explains why someone will hold on to a plummeting stock for years just to avoid the pain of realizing the loss, while selling a winning stock way too early just for that quick dopamine hit. Moving right along to Section 4, the specific theories driving our financial decisions. The legendary behavioral economist Richard Thaler introduced this amazing concept called mental accounting. From a purely mathematical standpoint, money is perfectly fungible. A dollar is a dollar, right? Well, our brains don't actually work that way. Think about mental accounting in a successful Montreal cafe. The owner gets a surprise $5,000 tax refund. Instead of treating this rationally, like putting it toward business debt or savings, the owner mentally files it away as free money and splurges on a luxury espresso machine they don't even need. The source of the money irrationally dictated how it was spent. Then there's the framing effect. This basically proves that how an opportunity is presented completely rewires our risk assessments. If I pitch you a new business venture and say, hey, this has a 90% chance of success, you're probably going to jump right on board. But if I pitch the exact same venture and say, this has a 10% chance of failure, suddenly you're highly risk-averse. The math is literally identical, but the framing changes the whole shebang.
So let's look at Section 5, market impacts and hurting.
What happens when millions of people make these emotional mistakes all at once? Well, you get herding behavior. This is when investors totally abandon their own independent analysis and just blindly mimic the crowd. Whether it's driven by FOMO during a raging bull market or sheer panic during a crash, this herding directly creates severe market anomalies. It is the exact psychological engine behind massive speculative bubbles, and it proves without a doubt that financial markets are not perfectly efficient. Finally, we've arrived at Section 6, practical strategies and applications.
Awareness is honestly half the battle. Once you know your brain is flawed, you, as a future financial planner or a small business owner, can actively manage that risk. You bypass your emotional brain by using disciplined, structured strategies. We're talking about utilizing index funds and automated rebalancing to stop yourself from panic selling. It means using robo-advisors that stick strictly to your risk tolerance, taking the emotion out of trading entirely. And in the corporate world, it means executives intentionally setting up checks and balances to counter their own optimism bias when forecasting a project's returns.
On a macro level, HR departments and policymakers are actually using behavioral finance to design what we call nudges. A perfect example is employee retirement plans. Instead of asking employees to actively opt into a savings plan, which, let's face it, we all procrastinate on, companies now default employees into the plan, requiring them to opt out. This is brilliant because it leverages our natural human laziness to improve our long-term financial health, achieving way higher savings rates without restricting anyone's freedom to choose. All right, as we wrap up today's explainer, I want to leave you with a bit of a challenge. Close your notebooks for a second and be completely honest with yourself. Knowing everything we just covered, knowing that your brain is quite literally wired to make irrational, emotionally driven choices with money, what cognitive or emotional bias is secretly managing your portfolio right now? Going forward, are your financial decisions going to be guided by logic and strategy, or are they going to be hijacked by your own psychology? Something to think about. Thank you so much for joining me for this session on behavioral finance, and I'll catch you in the next explainer.